Let's talk about the income statement. So far in this class, we've started a little slow. We did chapter 1 that gave us an overview of the importance of financial accounting and the environment in which we operate, how regulated the profession is. And in chapter 2, we've looked at the theory of measurement and of reporting. And in chapter 3, we've taken time to do some review of things you should have learned in your first accounting class. Now we're off to new things. And so while we say income statement, this is different than the income statement you learned before. Let's review some things that will be different. One is that we're going to learn the income statement is reported in sections, okay? And they have to come in a certain order. We're going to learn about that. We're going to learn that income has to be reported per share of stock, and how that happens. Now, there's a whole chapter on that later in Intermediate 2. We're going to get the simple part of it now. And then we're going to learn something about the reporting of comprehensive income. So there's a new term for you, I think. Comprehensive income and how that's reported. So my intent now is to look at the format of the income statement, the sections report, the order in which they come, and how we report earnings per share. I'm not giving any detail. These are the sections. This is the order. Here we go. So we start with income from continuing operations. Now, this section is where we report all the things you've come to know and love. We report sales, cost of goods sold, operating expenses, miscellaneous gains and losses, interest expense, and tax expenses. Now, ordinarily, if you did all those things, the title you'd come up with would be net income. And that's still the correct title if you don't have any other sections we're going to talk about. But if you do have the other sections, all the other sections, then the next item we want to include is income from discontinued operations. Now, this should be easy to remember. So the first item is continuing, and the next item is that's not continuing. It's the discontinued part. Now, what we want to do here is take the income from operating any component of the company you're going to discontinue or have discontinued. Do there any gains or losses you got from selling off the assets, and report them as discontinued operations. Now, the word component is a technical term, and you want to know its definition. But what we're trying to do here is you take income from continuing operations, and you want to be able to predict the future. And so we say, here's part of the company, and we expect it to be ongoing. Okay, here's part of the company we expect to be ongoing, and thus we might be able to predict income the next period or sales or whatever. But the part of the company that's not ongoing, it becomes useless or irrelevant to any decision about the future, because you're not going to have it in the future. So we want to separate that part out. Okay, now if we were to add those two together, and if there were no other sections, then add those two together, you'd get net income. But assuming there are other sections, the appropriate title for adding those two together would be income before extraordinary items. Or if you know there's only, if it's a gain, you'd say income before extraordinary gain. Or if it's a loss, income before extraordinary loss. But you get the idea. It's income before extraordinary, whatever it is. And this is an appropriate title, and it should give you a hint as to what comes next. Okay. So after the title, income from extraordinary items, we're going to have any extraordinary gains and losses. Now, extraordinary is a technical term as well. An extraordinary gain or loss is a gain or loss that is unusual in its nature, considering the environment in which the firm operates, and it is infrequent in its occurrence for this individual firm. Okay? So it's unusual in the environment or unusual industry or the location where this firm operates, and it's infrequent for this individual firm. We don't expect it to happen again. A common example and an easy example would be something related to natural disasters and the weather. So, for example, an earthquake is always extraordinary because no matter what environment you're in, earthquakes are unusual. And earthquake losses are unusual, and you don't expect them to happen again. Okay, in your location to your business. Okay. Now, on the other hand, consider a citrus grower in Florida that has damage to the citrus crop every few years. Okay, so when frost damages or destroys the orange crop and we incur a loss, that is not extraordinary. It's not extraordinary because in the environment in which we operate, we get these every now and again. And in our firm, we expect that sometime in the next few years we'll have frost again. Okay, so that would not be extraordinary. Now, if we add all that together, now we come to this lovely item you all are so familiar with, and that is net income. Okay, so we've added a few sections. Now, in that first section, income from continuing operations, again, that's what you've learned already, and it can be reported in several different ways. But the two major ways we would think of would be a single step format, where you took your revenues and gains and put them all together, and then your expenses and losses, put them all together, and in one subtraction, and you got income from continuing operations before tax. And the other extreme of that then would be your multi-step income statement, with multiple steps or multiple subtotals of income. You have sales minus cost of goods sold gives you gross profit. You subtract out operating expenses, you get operating income or income from operations, and then you add and subtract the other things to get income from continuing operations before tax. So you can do that multi-step, single step, or some hybrid in the middle. Your authors, by the way they say it and their reference to figure 4.1, give you the impression that if you have multiple sections, continuing operations, discontinued, that's a multi-step income statement. That's not. Every income statement will have those sections if you have items to put in. Multi versus single step refers only to how you present the very first section, income from continuing operations. Now, after net income, we're required to report, if we have subsidiaries that are not 100% owned by the parent. That means there are some minority shareholders in the subsidiary. We want to subtract their interest in net income out to get the interest in net income of the majority shareholders or of the parent company shareholders. So we report net income for the whole consolidated group, for all those companies together. And then we subtract out the portion of that net income that pertains to the minority shareholders in any subsidiaries this company might control. Okay. Then we're also required to report earnings per share. So at the end of the income statement, after reporting net income, we report per share. And it's not just net income per share, we have to report it for each of the segments or sections we reported. Income from continuing operations, income from discontinued operations, extraordinary gains and losses, and net income. Okay? So that is the income statement in all of its sections. They have to come in that order. One more thing we ought to note, the authors call this intra-period tax allocation. This is a technical and jargonous term for a simple thing. And that is this, that each of these sections of the income statement will account for its own tax. Okay? So when we calculate income from continuing operations before tax, we're going to figure out what is the tax effect, what is the amount of tax we'd have to pay on that amount of income. And that will be what we report as tax expense that we use to get to income from continuing operations. Any tax effect from discontinued operations or any tax effect from any of these extraordinary gains or losses will be reported in that section. So for example, say we had an extraordinary gain of $100,000 and the tax rate is 40%. So we have a $100,000 extraordinary gain, we'd subtract out $40,000 of tax expense and report the net extraordinary gain of the $60,000. Okay, so each section accounts for its own tax. Okay, and that'll do it. Have fun with the income statement.